Hi, everyone. Welcome to our second quarter webcast. Today, together with me, I have Adityani, Brandon Breen, and Tao Pan. We're going to talk about the outlook for credit markets in the next 20 minutes and the recent risks that have moved, especially European credit markets, and what we see upcoming in the second half with elections in France, obviously, and the UK, but also elections in the US. So we started the year with a lot of positive expectations, with 6 cuts priced in the US from the Fed, and also a lot of cuts in Europe. And today we have 2 cuts. The market has done really well, though, despite these withdrawal of easing. And we think that simply part of the reason is that central bankers have been tightening with one hand, but they've actually been easing with the other. So essentially, the front-end tightening with the 5% front-end interest rate has not really reached the whole of the economy. Large companies, but also high-yield companies, have continue to fund with long-term maturities. And so with inverted curves, that means that the pressure of high interest rates at the front end is not really getting to everyone. And at the same time, fiscal deficits are what matters. We are continuing to be in a fiscal dominance environment. And that means that with governments continuing to spend at 7% in the US and 3 to 4% in Europe, the recession that a lot of economists were hoping for or thinking about, has not really happened. So where are we in credit markets right now? Spreads are tighter, but there's been a recent widening, and we continue to have some bumps, particularly in Europe, which is one of the areas where there's more underweights. It's maybe less loved by investors compared to the most crowded popular longs in the US, and one of the areas where there's still more value. So we are close to tight spread. We were close to the tightest spreads since pre-COVID in a few weeks ago, but today, we have slightly wider levels, and we've particularly widened into some areas of the market, which we'll talk about. Now, typically, when there is political volatility, when things widen for the wrong reasons, it's an opportunity. So we're here to say that, some of this volatility is actually pretty good, and there are some interesting entry points right now in the market, which we haven't seen since October last year, and then previously with Credit Suisse. So we continue to be in an environment of Goldilocks, but then this equilibrium, which is essentially micromanaged by central bankers, by the expansion of balance sheets and by fiscal policy, which go against the front end. It's this period of Goldilocks and soft landing is sometimes interrupted by bumps, and this is one of those bumps where we think there's an entry point. I mean, overall, rates levels are high and spread levels are relatively tight, so it's a good environment for an active approach to credit, not necessarily a great environment for being long or long all the time, which was something that worked in the past 2 years. Today, we have to be more nimble. We have to pick our spots and the areas of value. And so overall, the market is not that attractive. There's a lot of things that in credit look interesting. There's high all-in yields, and a lot of investors are going into private, and a lot of investors are being attracted by these 10% all-in yields. But it's very easy. Credit is a good place to be for sure, but it's very easy to be in the wrong parts of the market. So we really don't like to be in a strategy that locks capital, in a strategy that's passive right now, because investors would lose the optionality of trading these vol events and these bumps, which we think are going to be more frequent going forward. So compared to where we were a few months ago, the spreads have gone up a little bit, but we still see crowded longs in the left side of the credit spectrum, the safe side, so investment grade, and also in the right side, the riskier side, which is unsecured, private assets, things that promise double-digit yields, but that's again a capped yield. What is going on under the hood? There's a lot of quietness in the market on the top, but then under the hood, there's been a discussion around weakness in the job market, some weakness in retail sales, some weakness in credit, what's happening with credit cards, what's happening with bank lending. So we do see some signs of stress after so many quarters with 5% interest rates at the Fed. However, this stress is coming especially in the weakest areas of the consumer and the weakest areas of the corporate spectrum. So in other words, the weakest, smaller firms that are funding with floating rate securities, floating rate loans are getting hurt. People with credit cards are getting hurt. All the loans are getting hurt, but large firms are not. And that's why we continue to be in a relatively subdued, in a very gradual default environment. So yes, there are some signs of stress in unsecured credit, in consumer loans, and in credit cards, and in CRE, but it's not something that is systemic, and it's not something that will affect large firms. In fact, what we see at the corporate level, looking at the lending surveys by the ECB and the Fed, is that essentially lending standards are pretty loose. So large firms can refinance relatively easily with banks, and if not with banks, there is several private credit funds that are competing to fund to these firms. If we look at liquidity, therefore, we don't really see the signs of a strong tightening by central banks. So we continue to have a good fundamental liquidity backdrop for credit. And if we look at fundamentals of the micro world of corporates, then leverage is still very contained, and the maturity wall has been pushed forward to 2026, 27. So in other words, even the names that are pretty weak and names that have gone into stress, we remember Intrum earlier in the year, Altice SFR, Ardagh, Loan Curve. There are a lot of names that have gone into stress, but many of these names are able to refinance and kick the can thanks to available financing. And this financing is available because curves are inverted and long-term investors continue to allocate to risky assets. So therefore, what we see is a very interesting environment where defaults are rising, but they're rising slowly. So it's not a systemic, market-wide distress, or not a COVID type of sell-off. And we don't think that's going to be created by the French elections. A lot of investors would like to have that kind of sell-off. It's a gradual dispersion. It's a gradual sector-by-sector sell-off, with defaults going from 2 to around 4% in European high yield, and towards 5% in US high yield. This is evolving in line with our forecast. We talked about this in the first quarter as well, and last year, defaults are rising, but they're rising very slowly. Investors have the time to distinguish between good firms, bad firms, and the ugly firms, the survivors, which are paying more to bondholders. So from that perspective, credit is a good place to be if you have the right margin of safety and if you're in the right firms that can survive. And you're actually having the upper end compared to shareholders for the first time in a long time. As a bondholder, you're able to receive a lot more of that EBITDA compared to shareholders. Now, against this backdrop, it's important to understand also how liquidity, so monetary policy and fiscal policy will change going forward. And we've seen obviously a withdrawal of all these easing expectations that were built in at the beginning of the year, with central banks moving from 6 cuts to 2 at the Fed and also at the ECB level. There are still a lot of cuts pressed into 2025. We think that potentially some of those cuts may be also pushed back even further. And we've seen that 2 weeks ago, the ECB pushed back against automatic cuts, and the Fed did the same last week in a relatively hawkish press conference. So as the economy continues to hum along and fiscal spending continues to stay strong, it's possible that we might see a little bit, less cuts, fewer cuts in 2025 than we expect. Is it a worry? Well, the rates market is still pricing a relatively normal cutting cycle, not very deep. It's more shallow than it used to be, but it's pricing a persistent cutting cycle. In other words, a probability of a lot of cuts next year if we get 1 or 2 cuts this year. But there is a chance that fiscal policy might continue to surprise, and therefore that the rate cuts may be 1 or 2. Not a one and done story, but almost. And that's a risk that is underestimated by rates markets, and potentially also in credit markets, the expectations is for more cuts. So it's one of the things that could create some more volatility. Now, in our model for the analysis of Fed and ECB language, what we are actually seeing is that both the Fed and the ECB are a little bit more hawkish than they used to be. So, they've been talking about a pivot and talking about cuts since November last year, and now they're pushing a little bit the brake pedal to rein in the expectations of the market. So this could be a catalyst for further volatility. persistent inflation and central banks pushing back on rate cut expectations. And the other catalyst for volatility, obviously, is political risk. But we have to keep in mind that, even though data has been weak, we have to keep in mind that central banks have continued to ease with the balance sheet. They've hiked rates with the front end, but they've continued to ease with the balance sheet. And central bank balance sheets are no longer falling since the tapering of quantitative tightening. And you can see that on the left, the volume of balance sheets has not come down that much. And on the right, we might actually see an increase in balance sheets in the coming months. And obviously, the balance sheet helps asset owners, it helps large firms, it helps the long end of the curve. And even indirectly with the bank term funding program, which is essentially like a TLTRO in the US, central banks have controlled the volatility of long end yields. So how can this Goldilocks environment break? We've been in a situation where the front end hikes are doing something against inflation, but effectively central banks are keeping the long end inverted. Yellen, the US Treasury Secretary, is shifting maturities to issue only in the front end. The Fed has launched the bank term funding program, and essentially every point of volatility in the long end has been smoothed by some of these initiatives. And therefore, credit spreads remain low and stock prices have continued to trend higher. Well, there is a risk. It's unpopular now, it's contrarian, but there is a risk that fiscal spending continues and that inflation might be a little bit stickier than usual. This is what the Fed and the ECB are worried about. Now, one opinion is that they might be backward looking. They might be worried about not making the transitory mistake all over again and not look bad. But there's also a chance that they might know something we don't, which is that negotiations in the labor market are being more heated than we think. In Germany, there's a discussion about a 7% raise. And that the one-off effects that have brought inflation down, like immigration, for example, or the reopening of supply chains, might not repeat themselves again. And so as a result, we do see inflation at 3% at the end of this year. So our model still estimates sticky inflation, and potentially there is a path upward or a sticky path if we have higher energy prices, higher commodity prices, higher metal prices, and fiscal spending that continues to be persistent. Now, why are we talking about this? Not because it's an amazing base case scenario. I mean, the base case scenario is still Goldilocks, but because it's very underestimated by markets. Everyone continues to price a normal cycle rate cutting path with a reversal to a neutral interest rate that might be, around 3%, and inflation might go back to 2%. We might be in a different world. It's very important because it has deep implications for credit markets, for the type of credits that you buy and the type of credit strategies that you invest in. And I think here what's been underestimated is politics. There's a lot of attention on monetary policy and interest rates, but politics in the end is going to drive growth. And we have seen already that it's because of fiscal deficits that we have avoided a recession. So our base case for the US elections in 2024 is a Trump victory. And we currently estimate, based on public data, based on polls and our Monte Carlo simulation of that data, that the Biden administration has only a very slim chance, around a quarter, so around 25% chance to be reelected. Now, obviously, things can change, but we do think that a Trump administration would have very strong and widespread implications in terms of trade policy, and potentially also in terms of the deficit, depending on the Congress configuration. In a Republican Congress, obviously, there would be even more deficit. But with the first Trump administration, the main change that we saw is that fiscal policy became pro-cyclical. In other words, deficits remained persistent, even with very low unemployment. This obviously continued during COVID and with the Biden administration. It will continue in 2025 if the Trump administration gets elected. It might revamp term premium in the long end of the US curve. Currently, this is the simulation that of the outcomes, of the electoral outcomes that we have run together with Tao, with the public data available from the state-by-state polls in the US currently available. So Tal will go through a bit more on the methodology if there are questions, but it's something that we think the market has not completely come to grasp yet. Obviously, the projections from the CBO already forecast a rise in deficit in the US and an accumulation of debt, which is concerning. But again, it's not reflected in the term premium. It's not reflected in the steepness of the curve, which is currently inverted. So we're more worried about a reacceleration and a volatility in the long end than we are worried about a recession. And the reason why is also that estimating the impact of rate cuts or the impact of an additional point of deficit on the growth trajectory suggests that a couple of rate cuts or 1 percentage point of extra deficit are enough to keep the US growth above average. So that's obviously positive for credit. If we see an environment where inflation is sticky above 2%, but not out of control, and deficits continue, well, you really don't want to be in public debt. You don't want to be in treasuries or OATs or BDPs. You want to be in credit. And probably we continue to hum along above trend. Obviously, after many years above trend, the normal economist forecast would be for growth to go back to trend or potentially to go have a recession. But again, fiscal spending extends the cycle and rate cuts can extend the cycle a bit further. In the meantime, we have sectors that are fragile, sectors that are not used to living with 5% interest rates, and those sectors and names will restructure. And we continue to see that, which is an opportunity for us. Now, moving back to Europe, obviously we have the UK election, which is very well flagged in July and Labour winning. But the French election is more of a question mark, and we in the configuration of Parliament, we essentially have three scenarios. I mean, the base case scenario is of a hung Parliament where you don't have a clear coalition, and Macron's party, comes as a third party. The two other scenarios are of a right-wing or a left-wing majority, but they're very unlikely. And so in the base case scenario, we will have a cohabitation where the president will have to cooperate most likely with the right-wing party, and there will be some consequences for trade policy and for foreign policy, but unlikely we will see consequences for immediate consequences for fiscal policy. Very unlikely we will see discussions about Euro exit. And so some of the fears that have been put in the market recently for us are an entry point. I mean, it's a hung Parliament in France potentially means less spending. It doesn't mean that French banks have a credit risk problem or that Europe is close to an exit. And the ECB is a lot more vigilant when it comes to the banking system right now than it was 10 years ago. They're very prepared, they're very ready to assist. So typically what we see, especially when it comes to Europe, but also in general, is that investors are very focused on the near term, very focused on monetary policy, and sometimes the markets are not grasping completely what could happen to deficits, what could happen to the medium-term trajectory of government debt and the implications for the economy. And here, again, the end game is probably not an explosion of debt to GDP in France or in the US. The end game is a persistence of inflation above target, which will erode the real value of debt, the real value of the debt to GDP of European and US countries. In other words, debt balances become more sustainable with a 3% inflation than a 2% inflation. And what are governments spending for? Well, they're spending for inequality, against inequality. There's very high inequality. They're spending also to prevent unemployment from going up. They're spending to preserve the sustainability, the survival of corporates. And those include a lot of high-yield names, like from Telecom Italia to Lufthansa to Air France to Montepaschi to even Burger King in France got a credit line by the government. So why buy sovereign debt if you can invest in the right names where not just governments, not just stakeholders and shareholders, but also the government is potentially behind you? Are there other events that we're worried about in the second half of the year? Well, it's very important to think about the divergence between the US and the rest of the world, especially if we have the potential for a pro-cyclical fiscal policy into 2025, which we think will happen regardless of who wins. Then there could be more US exceptionalism, which obviously is also built on a high deficit, and more divergence between the dollar and other places in the world. And so one area to monitor is the BOJ. The BOJ has been the anchor for global long-term yields. Japan has been spending this year, in the last few months, as much as they spend pretty much, in the past few years, in terms of to preserve the equilibrium in dollar yen. So should the US continue to accelerate, recent data has been softer, so it's been benign, but should the US continue to accelerate, then we might see some volatility in the long end of rates. So as you can understand, we don't like duration too much here. We don't think you get paid very well in a slowdown with the current duration, with the current inversion of curves. And we think, rate cuts will still be less than what people expect. But we do like credit in the right areas. US credit is very overcrowded and very popular. Investment grade credit is essentially a duration play with a long-term extension, long-term maturity. We do like specific areas in high yield that we were going to talk about. The other question that we haven't discussed is, is what China will do. And in China, we continue to see more stimulus, enough probably to cap a downside scenario, but still not enough to reignite the economy, especially, some of the measures that we're seeing are more aggressive. It's a positive for Europe, but we think it's more a positive in terms of survival and gradual restructuring rather than, a strong reacceleration. But there is a chance of reacceleration, which is not priced in, again, ignored by markets, and it's becoming a little bit more likely. We wouldn't trade it in China. There's very few things that, are interesting in credit, but there are other areas of the world that have upside. So, how are we investing right now? Before I turn to Adi for some of our positioning and essentially discussion of things we like and dislike, I would say that what we want to do right now is we are in an extended cycle. We definitely are still in a good environment for credit. But we want to have some margin of safety, which means being in the right names, being in names that are strong, that have shareholder support or government support, and generally being in names that have options to survive a high rate environment. And a lot of what we've seen in the last 18 months is that even the names that were weak have survived and kicked the can because of the pivot party, the expectations of a lot of cuts. Now we have stickier inflation, we have slightly weaker growth, slightly weaker into elections, but central banks are saying, we're not going to cut as much as you think. So we might be in an environment where, rates don't go back from 5 to 3% that quickly, and that's good for bondholders, but it's very easy to be in the wrong parts of credit. And so we are very careful about being in the right parts of credit in the areas that have margin of safety. What are these areas? What do we like today?
So as Alberto was saying before, effectively, when we look at on our long side, there are two aspects of it that we focus on. One are where we get a margin of safety, where we're paid basically for companies that have our free cash flow flat or positive, have either had deleveraging capital structures or have managed their debt and can survive a high rates environment. And then the second aspect of it is where we essentially see significant upside, either because of the convexity of the instrument or because essentially it has some kind of embedded equity optionality. From a sector perspective, where are we focusing? Firstly, we're focusing on industrials and autos. As Alberto was saying before, the market's been quick to price in higher recession odds in Europe, as well as discount the ability of China to re-stimulate, which means that a number of the European industrials and autos today are trading much wider than their fair value suggests, and also wider than where we would expect, where we see the US counterparts trading. An example of this, for example, will be something like Aston Martin, which trades above 500 spread. It's a company which is free cash flow flat this year, It has historically de-risked the capital structure, and last year they basically have refinanced a full cap structure. But ultimately, this is a company with strong shareholder support, and they have a path to sort of being more free cash flow positive with a deleveraging strategy. Another example of where we basically see the market overpricing in risk are in parts of the energy sector. Generally speaking, energy is trading pretty tight from the credit perspective. So we think about Total or BP and so forth. We've seen a significant sort of compression there. We've also seen a compression in names that historically we've been active in and continue to monitor and trade. Names like Enquest and Ithaca, which are UK producers. A name that we're now have been active in trading and continue to be active trading in is a name like Pemex, where effectively they've had Mexican elections. In May, it still trades about 500 to 550 basis points in spread. The government has been reelected. They've been reelected with the agenda of sort of continuing support for key infrastructure, one of which is Pemex. And we see continued government support of an equal magnitude as before, and we see this as a name that will tighten over the summer. Further, as we've discussed before, we like banks. European banks, especially periphery banks, have been trading wider than where we see fundamentals. In the widening that we had in the last few days, given the volatility in France, we've also been have been adding and trading French bank exposures. For example, Credit Agricole 81, with a duration of 3 to 4 years, trading at about 400 and to 440 spread. This is wider than this has been as wide as some German banks in some cases, or even UK banks. So it's been an opportunity for us to add. Finally, a part of the capital market where we continue to be active is the junior mezzanine, which, as Alberto said, is highlighting exactly one of the aspects where we're getting paid for default risk. In Europe, you're getting paid 500 spread today. It's essentially you're looking at about 10 points of upside over 2 years, effectively, including coupon, and there's a significant equity buffer below you. On the short side, what are the aspects that we're looking at? Ultimately, we're looking at fragile capital structures, though they can either come from the fact that they're exposed to a weaker consumer, or they might come from the fact that they have a weak capital structure to begin with, and they cannot deal with this new higher rates environment. On the weak consumer side, we'll focus on the IG cyclicals, where we're sort of shorting things like Best Buy and so forth, which are trading at under 100 basis point spread for 4x leverage. On the capital structure side, or effectively the SPVs, names essentially that cannot survive a high interest rate environment. We continue to trade on the RV perspective, things like some US telecoms, as well as some US home brokers, which effectively need a lower rates environment to survive. Finally, we've also been in this environment, we continue to be actively trading BTPs. From the short aspect, given this widening we now had in France, we've been using that as well.
Thank you. And I think one question I have after discussing our general stance is how do we think about maybe briefly some of the names that are most interesting, and on top of the sectors that make sense from macro perspective, we've been doing a lot more idiosyncratic work, and it's a very ripe environment for special situations. So Brendan, can you give us just a quick overview of some of the examples of special situations and more idiosyncratic situations that you're looking at right now?
Yeah, sure, Alberto. So, I mean, one name that's been beaten up a lot this year has been Grifols, which had various short seller reports, but we've kind of done a lot of work on the business, and we've been able to position in the shorter dated part of the structure, and we've had more positive news over asset sales and being able to obtain private capital, which Alberto mentioned is very much a theme in this market. So that's something that we still like. There's also something like Macy's, which we've touched on before. Again, this is a company that's performing a lot better than I think people had expected. There's the potential, quite a strong potential that we don't think has been adequately reflected in the bond prices of a takeout, compared to past cycles where there's been mooted LBOs of retail companies. There just hasn't been the provision of financing, whereas now we're in a different world where there's loads of dry powder on the table. And then there's other names where, you know, we're very, very comfortable with either the sponsor or, which we think is becoming increasingly more relevant today, the covenant package, something like a Stonegate or an International Design, or even some of the more challenged autos, which I think Ali reflected on, such as Tenneco or Nagelpelzer, names that have had a very difficult past. But, you know, when you do the work and you see how they're dealing with inflation, how, you know, their order books are quite strong, how the sectors are holding up, you know, we can take a lot of comfort, and we think those are areas that have been mispriced. And then just very lastly, in terms of special sits, one area we still really like is some of the Ukrainian corporates like Metinvest, etc. You know, we've had the pleasure of meeting management over the past couple of weeks, and this is somewhere we think is still very interesting.
Thank you. Yeah, so as you can see from this chart, the dispersion across sectors remains pretty large. There are some sectors we don't like. Real estate, we think, is a low quality duration trade. It's a trade where you are betting on rates to go back down. But what we like are companies that are dealing with maturities, that are dealing with high financing costs, and that can pass on these costs to consumers. And that's the common denominator of what we like. We also don't like being subordinated, being in a junior part of the cap structure, and being in locked instruments, or being in a liquid market, because the volatility that we will see from politics, from interest rates, and from other events in the coming months is something that we want to monetize. So, you know, getting 10% in private credit with a 5-year lockup is probably, you know, one of the not so great decisions you can make in credit right now, with a relatively tiny premium versus public markets, which are basically just on average 100 to 200 bips less, but probably not that much less. So we like a smile. We like to have convexity right now. That's how our portfolio is positioned. We cannot talk about individual positions, and some of the things we discussed over the call are examples, but we do have a smile, and you can see that the convexity that you have, not just in credit, but also in convertibles, gives substantial upside if the market continues to go. And in areas where credit spreads are tight, then, you know, other instruments can provide better upside, like, for example, convertibles, which are below par or on par. And generally, this upside, we think about it not just in terms of credit spreads, but also in terms of inflation and higher earnings. So ultimately, you want to have, in an environment of 3% inflation, you know, 5 to 7% fiscal deficits. You want to have assets that are linked to real cash flows. So I'm going to close with a story. I was in Frankfurt 2 months ago, meeting with some of the members of the ECB, and one of the questions they asked to the working group that meets with them, and I've been there for over 10 years, is why are people so bullish on risk assets? And I said, the real question is not why people are bullish on risk assets, but is why investors are so bearish on central banks. And the reason why we see investors buying gold and buying Standard & Poor stocks, especially the tech stocks, buying private credit, buying real estate all at the same time, is that there is a fear, in our view, of a persistent sticky inflation above target, or in other words, of a de facto revision of inflation targets from 2% to 2.5% or 3%. And in that environment, a BTP at 4 is not enough. A Treasury 10-year at 4 is not enough. So you want more yield, and you want more alpha. So we do think that central banks will push back, initially at least, against a deeper cutting cycle, because they're aware that inflation is sticky. Inflation might be a little bit stickier than per unit of growth than we think. The real question mark is politics. And if we see Le Pen in France and Trump in the US having more influence or being elected, that means probably in the medium term more fiscal profligacy. So higher deficits, which in turn means stickier inflation, and it's a higher nominal rate environment. Then we have to see which central banks have the willingness and which ones have the ability to keep rates high for very long. For credit, you get good all-in yields, but you don't want to give up your optionality. You don't want to give up your optionality in locked type of strategies. You want to be able to trade here. And probably the second half will be a bit more volatile than the first half, You know, we've been up every month last year and this year. We are not afraid of vol. We're very happy to deploy not just relative value, but also some directionality, adding some directionality in moments of vol like the one that we saw over the last 2 weeks. And with that, I'm going to turn it to Q&A. And please do ask questions in the chat. We're going to summarize them, and we're going to, you know, to give you some quick answers. In the meantime, I want to ask Tal the question, the most important question maybe, which is how did you come up with a 20-25% Biden victory, and what is our methodology for understanding electoral outcomes? You know, how has it worked in the past? Because Tal has a good track of forecasting Brexit and forecasting Trump in 2016 and the Macron victory in 2017. So what is your magic trick for electoral forecasting and methodology?
Yeah, thank you, Alberto. And like Alberto was saying, we do have our very specific and special framework in terms of election projection and tracking. So in this case, for the US presidential election this year, if people just look at the polls, the national polls between Trump and Biden, they may think it's a toss-up, like the two of them are basically very close to each other, and maybe Trump only enjoys like 1 to 2 point of lead. However, the analysis just looking at national polls will miss a lot of points in the by-state polls, which is very important in the US election system, where the overall popular vote doesn't matter as much when it comes to the electoral college votes. So what we do in our methodology is we actually go down to each state, looking at the state polls, which is a very large database. And we look at especially the swing states, and we simulate the how the vote would go in each state with some room for error, given how much the polls have been swinging over the past several months. And then we project how many votes each candidate is likely to get. And based on the simulation where we run every time 10,000 times of run for each state, and based on that, currently Trump's position is actually much stronger than the national polls suggest, which give him 80% probability, which is even higher than the betting market odds, while giving only Biden 20%. And this is very largely because in a lot of the swing states, Trump has actually gained advantages since the last election in 2020. And in states, especially like Pennsylvania, Arizona, Georgia, where Biden actually did better in 2020, this time the polls have actually moved quite decisively towards Trump in favor. Of course, we are still a bit early in the election cycle and we haven't had the debates yet, but our analysis basically shows Biden is actually in a much more challenging position and Trump is actually in a stronger position than most people are thinking at this moment. Thank you.
Thank you, Tal.
Thanks, Al. I think we've got a few questions, but I appreciate we're running out of time. So what I'm going to do is I'm going to summarize at least my summary of the questions, which is, given what Dow just said, and given what we see along the odds are, the implied odds of a Trump victory, why is the market not pricing in a higher probability of this event? Is it a function of time? Is it a function of just general uncertainty of geopolitics? It'd be interesting to get your view on that.
Yeah, I think that we keep asking ourselves this question, and essentially we've seen that markets tend to focus on fiscal deficits and generally on politics with around 1 or 2 months before the event. So there's been some discussion that's starting right now in the last few days, but there's been very little positioning on this event, and all the focus this year has been on the central bank rate cut story, which has turned out to be less interesting. So, according to this, we would say that the second half is going to be a little more interesting than the first, because we had a common theme driving all the markets in the first half, which was central banks are the only game in town, and now we're going to see more divergence in fiscal policy and potentially more volatility around tariffs and and also more divergence between the US and the rest of the world from the point of view of defense and the dollar. So there's a lot of implications of what could happen. Generally speaking, we still see that this is a good environment for credit, but like we said before, it's easy to be in the wrong parts of credit. So in the parts that have only carry left, and we want to be in the parts that have some upside left, or at least more upside than downside. And I think we're good with questions. There's a lot to talk about. We're happy to take your questions on a one-to-one basis. We're always around for discussion. And thank you so much for dialing in. Please keep in touch and look out for the Silver Bullet as well, which is our newsletter. Thank you.